Well, let's focus on the quick commerce stocks. Zomato yesterday slipped in trade as rising competition in the QSR space has pushed back margin expansion and also has driven faster network rollout. Swiggy was also dragged down. Now we're joined by Karan Turani, Senior Vice President, Research Analyst, Media, Consumer, Discretionary and Internet at Elara Capital. Hi, Karan. Good morning and good to see you in. Karan, I think the header of your note was, they're making a pit stop in the longer lap. So what do you suggest? On Zomato, post that beak showing and the kind of drubbing that we have seen, people were interested at 250, 270, 280, at 210, 220. Would you be a buyer?
Hi, Nigel. Good morning. I think I will definitely, like to buy Zomato at 200, 220 levels. I would recommend a buy rather. What we have seen right now is, a lot of exaggeration and overreaction, as far as quick commerce competitive intensity is concerned. We do have new players coming in, e-commerce will eventually get into quick commerce, but we don't see a price war for now. If there is a situation of a very sharp price war, wherein prices come off by 20%, 25%, discounting increases in a very big manner, then the losses can really magnify from here on. But as of now, e-commerce companies are not going to go into a price war. They are just trying to come into this segment because they don't want to miss out this opportunity and they want to make the most out of it. So, very clearly, quick commerce, e-commerce, both are going to coexist. There is nothing that, quick commerce will eat up into e-commerce in a very big manner. Of course, there are certain categories where they will end up, gaining market share, but there are certain categories which will only appeal to e-commerce. So very clearly, I think, it's obviously troublesome right now because of the increased number of players. You are seeing fragmentation, you are seeing competition, but doesn't seem to be so alarming as the share price is suggesting right now.
Karan, you've been optimistic on Zomato for a while and you've made that stance. I remember this conversation. We did this a couple of, I think, months back or weeks back, exactly discussing the competitive landscape and you're maintaining your stance. But, here's this, that Zomato press release openly coming out and saying and acknowledging the competitive intensity, even before the giants have come in, the, e-commerce giants like Amazon have announced an official entry. I think that's kind of spooked the street to an extent because you don't even have an official, big player coming in and yet they're saying that the margin expansion has been put on hold. That tells us the existing players between Swiggy, Zomato, Zepto, etc., between them itself, without a major new disruptor, there is a lot of competition. So, just walk us through what makes you retain that optimism and also the other factor why the stock sold off. One was the competitive intensity. The other factor why the stock sold off was the fact that they are front-loading all their, store rollout expenses, right? They're at, I think, 1,000 now. They're saying they'll be at 2,000 by December 25, which is obviously going to eat into profitability. So what is the window that you're giving for this to play out before they get back on the margin expansion trajectory?
So, Surabhi, in the near term, there could be, some kind of a minor price war, but, this is not a sustainable thing. Quick commerce business in terms of economics, you can't keep on burning money for 1 year, 2 year, and then, kind of sustain the business. Eventually, what will happen is that the players might move out of the market, players might kind of move out of this business rather, right? So I think quick commerce is a business wherein you can't really do steep discounting. It is a business in terms of user experience, great lead times, giving the customer the right product at the right time. Now, if you look at this situation right now of the players coming in, there are players like Zepto and Instamart who have got aggressive. They are doing steep discounting. This might sustain in the near term. This might put some pressure on Zomato in terms of profitability. But that is not the only reason why Zomato has delayed the plans for profitability. The bigger reason is higher throughput per store. So whatever new stores that they are opening in right now in the non-metro markets, in the new markets, they are not able to experience high throughput. That's one very big reason. And second, of course, you pointed about the expansion plan. So these are two major reasons apart from the price war in the near term, which has kind of delayed the profitability plans.
No, that's the point taken. But just to press on the point, if there are only 3 players, and that's an argument I've heard from a couple of investors as well, that, it's not sustainable because Zepto is also, Zepto wants to IPO and, they do 2 rounds of fundraise recently, so it won't go on. But if you expand that circle, and as Surabhi said, if you include some of the e-com players as well, why won't they enter if this is a very fast-growing, sustainable, long road kind of market? I mean, those guys have got very deep pockets, so it's not just 3 players. Yeah. And we've seen price wars, running for years. in those segments. Karan, go on.
Yeah, I'll come to that as well. So if you look at the e-commerce business as well, e-commerce players have been in India since many years. I think the entire language right now, or the entire comment right now, has changed from growth to profitability. If you look at the growth, there's a convergence in growth in terms of e-commerce companies from 40-50% to 15-20%. Two reasons: one is we are reasonably penetrated right now, and second, there's a very big focus on profitability. So, which is why I'm saying that beyond the point, I don't even see e-commerce companies stretching in terms of hefty losses. And the kind of losses Instamart is making, the kind of losses Zepto is making, 1,500 crores, 200 crores on an annualized basis, these are not small numbers. And I don't foresee e-commerce companies getting so deep in terms of making losses. They would rather try to focus on their own e-commerce business and try to make that profitable.
All right, Karan, let's hope that is the case for the sake of a lot of the quick commerce investors. And it pans out that way. But thank you very much, Karan. I wish we had more time and we could sort of have gone on, but we'll invite you again for some more conversation around this very interesting topic. We'll take a